October 26, 2018, 5 a.m. ET order reprints print article Agence France-Presse, Getty Images. When President Donald Trump first took on China over trade, it was easy to ignore because the impact hadn't hit corporate profits. No longer. During second quarter earnings season, companies said essentially the same thing, that they were monitoring tariffs. The market shrugged off trade concerns and stocks rose. Most of those earnings conference calls were held in July, which was before the latest round of tariffs went into effect. September saw a round of levies that encompassed $200 billion worth of Chinese products. Now, on third quarter calls, companies have begun to spell out tariff impacts in greater detail. Calculating the ultimate impact of tariffs isn't easy or precise. A fair calculation would include not only costs but changes in demand and the possibility of supply chain disruptions. The result could be significant. The International Monetary Fund lowered its global growth expectations when it released its recent outlook because of, in part, escalating trade tensions. Nearly every industrial company reporting results in October has mentioned tariffs. Caterpillar, ticker CAT, said the drag of higher input costs due to tariffs was $50 million more than its price increases. That $50 million is about 1.2% of the construction equipment maker's third quarter gross margin. Air conditioner maker Lennox International, LE, was more positive. It said that the 2.5% price gain it realized in the quarter more than made up for inflation and tariffs. Read more. AMD chief Lisa Su says the trade war is an opportunity for now. It appears that many companies are willing to eat the costs, and that could have a big impact on bottom lines. Barclays strategist Manish Deshpande's worst-case scenario is a 25% tariff on all Chinese goods imported to the U.S. Assuming that companies absorb the costs, Deshpande calculates that would shave 3 percentage points off the projected 10% growth for S. Of course, if pressure continues to mount, companies may have to raise prices. When Honeywell International (HUN) was asked on its earnings call about taking preemptive action on any new tariffs, such as price hikes, cost cuts, or alternative sourcing, executives said they were getting ready, but weren't pulling the trigger just yet. Companies seem to be willing to weather the cost storm for a couple quarters and hope for a resolution. They aren't making long-term decisions about sourcing, says J.O. Hambro portfolio manager Arun Daniel. The National Association of Manufacturers told Barron's it prefers a quick resolution. The trade group has pushed for an agreement that opens markets, protects intellectual property, and modernizes regulations. Daniel notes that Wall Street had a bifurcated outlook regarding trade. Some analysts are already counting on lower economic growth in 2019, but others aren't convinced growth will slow. That creates some opportunity if things calm down, but there needs to be a catalyst, Daniel adds. Trump and China President Xi Jinping's meeting at the G20 summit in November could be that catalyst. Any perception of a thaw or the announcement of a negotiating framework could lead to a relief rally in the sectors that have borne the brunt of the trade fears. Trade-linked stocks have been hit harder than other sectors. Information technology, industrials, and retail are all down more than the broader market this month. What qualifies as a workable framework? Rich Sega, global chief investment strategist at investment manager Conning, cites World Trade Organization data that shows the U.S. with an average tariff of about 3.5% across all imported products, with China at around 9%. A possible solution, getting to a middle ground. Just closing that gap a little could be all that is required for both sides to declare victory, Sega says. Write to Al Root at alan.root@dowjones.com. When President Donald Trump first took on China over trade, it was easy to ignore because the impact hadn't hit corporate profits. An error has occurred. Please try again later. Thank you. This article has been sent to